Hi everyone, just back from a holiday in Wales, and I can thoroughly recommend it, by the way, as it's a beautiful part of the UK. So anyway, I'm back and I'm all raring to go for another video for you. Anyway, in this one we're going to talk about interest rates and inflation and whether it's inevitable that if interests are going to go up, on what to do about it. The Bank of England and the government hope that the uptick in the domestic inflation is a temporary blip. Of course, they don't define the term temporary, but indications look like inflationary pressures may be with us for some time. Inflation is generally bad news as it erodes the value of money, drives up the cost of living, makes our goods look more expensive to other countries, and we can drive a wage price spiral leading to inflation rapidly going out of control. Traditionally, interest rates have been used to combat inflation, so our interest rate increase is just around the corner. Well, in this video we'll find out. I'm Anthony, and as always, we're talking money. Okay, interest rates are a pretty blunt but generally quite effective measure for bringing down inflation, and they do this simply by smothering demand within the economy. With reduced demand, prices come down and hey presto, inflation comes down. The theory goes that increased inflation rates make mortgages more expensive, credit, loan, company debt, etc. all more expensive, and in turn, if money is being spent on debt servicing, then less money is being spent on goods and services. However, interest rates have a rather annoying habit of affecting other things in the economy. First, with increased interest rates, our currency tends to appreciate. After all, if Mr. Foreigner can get more for their money by investing in UK debt than they were before, then they're more likely to buy more of it and therefore increase the demand for pounds, and therefore the pound goes up in value. With a more valuable currency, we can buy things cheaper from abroad, and as our economy has a propensity to import goods, cheaper imports means lower imported inflation too. So far so good. This all sounds like a fantastic way to combat inflation. The counterpart to this, though, is that exports become more expensive and demand for them from abroad can go down. The consequence is a trade deficit worsens. But although this can bring inflation down, I can sense you feeling a big but coming on, and you're absolutely right. And in the current climate, it's a very big but too. The pandemic and all the ramifications that have flowed from it means that the government borrowing level has gone through the roof. The furlough scheme alone has cost £70 billion and lost taxation on corporate profits, VAT and income, along with the vaccination programme, support for businesses and increased costs for the NHS has all added up to government debt that now stands at £2.2 trillion, which is a phenomenal amount of money. And even though a lot of this dates back decades, about 440 billion of it has been added in the last 18 months alone. But all of it needs to be paid for in terms of debt servicing in exactly the same way that you or I pay for our mortgage. Anyway, if you're £2.2 trillion in debt, the last thing you want is interest rates on that sum to suddenly increase. Now, if the bank rate is currently 0.1%, if rates increase to say 0.5%, then that's 5 times the cost of debt servicing. Now, okay, I know that's a little bit simplistic. In real life, it's a little bit different from that. But essentially, the government can ill afford to pay more than is absolutely necessary on such a large sum. The solution to very large debts like this is to inflate them away over time. 2.2 trillion in today's money is roughly half in 7 years' time if inflation is round about 5%. So the government has a very real incentive to increase inflation and keep interest rates low. Oh, hang on a sec, isn't that exactly what they're doing? Okay, so the other solution at the government's disposal of keeping some sort of control over inflation is not interest rates, but rather taxation. Taxation has the same effect on demand within the economy, but doesn't have that nasty effect of increased interest rates. So, increased taxation. Surely a government wouldn't do that in these stressful times, would they? Well, 1.25% increase in national insurance is exactly this strategy in action, and don't be surprised that more taxation will come our way in the short term if inflation becomes stubborn or worse still increases. Increased taxation can be subtle or not so subtle. Think of student loans, for example, reducing the threshold after which student loan repayments might have to be paid, or more fiscal drag where allowances stay the same regardless of whether inflation takes wages up higher or over and above these allowances. So using fiscal rather than monetary policy to control the levers in the economy is traditionally a socialist policy and not a conservative one. And you have to grudgingly admire how the Conservatives can flip from shifting the tiller to the left when it's expedient to do so. But this is not a political video, and whoever is in power would probably have done the same thing. One thing I will say about politics, though, is have you ever noticed that whoever's in power or in opposition, the future is always certain. It's only the past that's up for debate. Seems a strange way around of looking at things, but anyway, there we go. Anyway, where does that all leave us with regards to inflation and interest rates? Well, I suspect that whatever happens, we'll probably see an uptick in inflation. It will last longer than politicians or central banks initially thought, and it will be solved with a combination of tax increases and probably moderate interest rate increases too. So are shares just about to head south? Many people think so. In fact, there's lots of people, including professionals alike, who think that a great crash is just around the corner. They may, of course, be right, but bear markets do not necessarily need to follow bull runs. For the last 40 years, the general flow of things can be summarised by falling inflation, falling interest rates, rising bond prices, and hence falling bond yields, and increases in the price of risk assets such as shares. It's not always been a smooth line, of course, but that's the general trend. Now the whole lot looks like it's all going to run in reverse, so are we better just to sell up or ride out the storm? The reversal could be halted by central banks capping interest rates payable on government bonds, breaking the link between rising inflation and rising bond yields. If you think this is wishful thinking, there is precedent for it. In America, for example, after they joined the Second World War, they actively intervened to stop the yield on 10-year bonds rising above 2.5%. Essentially, the Fed bought bonds, increasing their price and driving down their yield to that 2.5% level. The problem with this, however, is that they arguably did it for too long, keeping buying bonds even as inflation took off. Quoting Mirren Somerset Webb of the FT, by 1948, US inflation, now bear in mind, does any of this sound familiar? Inflation was driven up by pent-up demand, supply shortages, and the 149% rise in the monetary base in a decade, and inflation peaked at 20%. Why would the US allow inflation to go to that level? They were not stupid people, or at least no more stupid than the ones in charge now. The reason is simple, and the US had a gigantic level of debt that was used to pay for the war effort, and they used inflation as a tool to erode the real level over time, while at the same time keeping interest rates low and thereby keeping debt servicing as low as possible. So will this happen this time around? Well, quite possibly. If so, let's face it, it may be best to assume it might, but what can we do about it? Well, there are two asset classes probably best to avoid, and that is government bonds and cash. The former is going to be kept low, giving lower yields than inflation, and the latter always yields less than inflation. So that leaves property, commodity, stocks, gold and crypto, and any other asset class you'd like to think of. Personally, and it's only my opinion, please give me your opinions in the comments section. We're really interested to see what you think, because I'm no expert in this at all. I like property. I like it held in a real estate investment trust scheme. That's a REIT or REIT. I'm not quite sure how you pronounce it, but anyway. And they invest in property such as supermarkets and offices and industrial estates and things like that. Property held directly, and especially property in residential, has more recently been the sharp end or been targeted by government taxation changes, and I'm not convinced that residential property prices will keep pace with inflation, especially if interest rates do tick up from what is now a very, very low level. Commodities tend to do well in inflationary times, and these can be invested in various funds available with companies such as Interactive Investor and Hargreaves Lansdown. Shares in banks and life assurances historically tend to do quite well in inflationary periods too, because basically they make more profit when interest rates go up. And shares that are closely linked to commodities tend to do quite well too. Although given the recent performance, you'd think otherwise. Looking at, say, miners like Rio Tinto and Everest and people like that, Frexpo and other ones which I hold, they seem to have headed south alongside the commodity performance. So maybe that's not a great one to go by. But anyway, Gold has a funny relationship with inflation, tending to show good protection or good correlation with high rates of inflation like we saw in the 1970s, but arguably not so much for moderate inflation that we've seen since that period. And lastly, cryptocurrencies. I only include this as an alternative. It has no proven track record as a hedge against inflation at all, partly because they're just such a new asset class, and its intrinsic real-world value is next to zero. But then you could argue that is also the case with gold too. To some, cryptocurrencies represent the ultimate protection against inflation of, say, fiat currencies, but to me, cryptocurrencies can devalue just as easily as any other currency, whether it's fiat or not. Others see cryptocurrencies as nothing more than a giant Ponzi scheme that will eventually collapse, as all Ponzi schemes eventually do. What we can be sure of, as with all of these asset classes, is that we'll probably see quite a bit of volatility over the next year with big swings up and down. That said, if you are invested in the UK market rather than the US one, we are by some standards undervalued and high yielding, and that might give us some extra layer of protection. Bear markets don't necessarily follow bull runs. We could just be in for a period of horizontal trading, as it were, without necessarily sharp, sustained declines as we would in a bear market. But anyway, let me know what you're thinking about the economy at the moment. Are we heading for a sustained inflation period? And what are you going to be doing about it? Click the like button and subscribe if you haven't done so already. It really helps the channel out. I'll catch you in the next video. But anyway, I'm Anthony, and as always, we're talking money. But bye for now.